much. While climate change and the global shift to a low-carbon economy present both significant opportunities and material risks for investment portfolios, yet many investors are not taking the impact of these trends into account and may severely be compromising future investment and financial market stability. Graham Sinclair, principal at SinCo, joins us now from the JSE for more on this topic. Thanks so much, Graham, for joining us this afternoon. Well, you're asking the question, are investors taking carbon and water risks into account? Before we get to that point, why should investors be taking it into account more so than they are right now?
Well, there's some realities that will play out over longer term. Some things we can see in the immediate. We can see farm protests, for example. That's not good for the industry. It's harder to see, though, that in 10, 20, 30 years, the actual climate would have changed that in the regions where those crops or those orchards are. So, for example, some of the climate change, and I'm not a climate scientist, but I've read this research, that there will be a changed weather pattern in the Western Cape. There'll be a changed weather pattern on the Highveld. And so the climate risks will play out. It's just a matter of when. There's now a phrase that's used, it's called the Anthropocene era. We're in the era now where humans have changed the shape of the earth, and that matters to every investor.
Graham, Lindsay in Cape Town, I can't really hear what you're saying from very well from the JSC, but we'll fix that. But a question that I hope you haven't already answered. You say that institutional investors are failing to systematically factor in climate change and freshwater risks when making investment decisions. The problem I have with that, apart from the fact that I think in the future it will be a worthy part of the investment decision process, is that these are, in my opinion anyway, imprecise sciences. I mean, there's so many different views on climate change. Between the 14th and the 17th centuries in London, for example, the Thames froze over, I think, 8 or 9 times. That was to do with climate change, but nobody could really pinpoint why it was. The freshwater risks, again, there seems to be no consensus. So how can people make investment decisions on something that is not clear-cut, like, for example, a CPI or a PMI figure?
Lindsay, I'd respectfully disagree with that view, and pretty much the most fundamental research, most recently out of Berkeley, University of California, a study was funded by so-called climate skeptics. They funded a comprehensive study of all the data points, kind of a meta study. And that researcher initially went in also with a skeptical framework. He came out and he had to say, look, honestly, as a scientist, I've checked all the data. My team's checked all the data. This is the most comprehensive research. It's called the BEST study. And the data checks out. So pretty much in kind of the reasoned part of debate is over. Now it's a question of how do you react to that information and how do you respond? So there's absolutely some thinking that needs to happen in the short term, in the medium term, and the long term about how investment portfolios will react. For example, in a water-scarce country, South Africa has the average rainfall much less than the global average. You have a food and beverage sector that's critical. Your previous segment was around issues in the agricultural sector, what the immediate billions of rands impact is going to be. Well, we'll face similar issues as the water availability changes. Maybe too much water, maybe too little water, and definitely, for example, in the Western Cape where your report was from, there's predicted to be less water. Anecdotally, for example, yeah, we all have met those farmers who are saying, look, I've got to change my growing patterns. I've got to change what I grow. For investors, it's critically important in South Africa, not just because the climate will change, literally, but also because in South Africa, as retirement funds, we're limited to investing globally. So we can't say, look, agree, disagree, but let me invest over the border somewhere else. In South Africa, retirement funds are ring-fenced. 80% of their assets have to be invested in fixed income or equity securities in South Africa. This matters to every citizen, every saver, and every pensioner.
Of course, for any investor, for this message to really hit home, Graham, we've got to take a closer look perhaps at the kind of constraints that this brings to returns specifically. Sure. So where do those constraints emanate?
Look, and here I would agree with Lindsay. It's not easy. I'm not suggesting it. SinCo doesn't suggest it's easy. Our work is figuring out the sustainable investment architecture. How do we integrate the environmental, social, and governance factors into the investment manufacturing process, into the strategy, into the asset allocation? No one said this was easy, but maybe that's why you pay the big bucks to the investment managers. That's why you have trustees who are stewards of capital. It's not easy, but there are ways to approach it. And one of the very simple recommendations coming out of the Navigating Muddy Waters, the 5-part research series commissioned by the WWF, some of the very simple next steps are, can we just at least record the facts? Let's count the CO2 emissions. Let's count how much water gets used to make some food or mine some coal. Let's at least count those in a regular, standardized, externally verified way. So at least whatever decision we take, we have the facts in front of us.
Graham, again, on the water scarcity and climate change impact, not only on investors, but on the companies in which they're potentially going to invest. I mean, I saw some research in one of the English newspapers over the last couple of weeks that says the reason that the Mayan civilization ultimately met its demise was not because of disease, but because of climate change. They just went through this incredible drought, and they had to move on. What happens? Which particular sectors of any economy are going to be hit the most? I would imagine that power generation, when it comes to water scarcity, is the first thing that comes to mind. Never mind agriculture, power generation.
Absolutely, and if you think about the inputs to power generation, South Africa sits on a coal-fired economy. Now, there's reasons for that, and absolutely, it's enabled South Africa to be the most powerful economy in Africa, but that's also kind of had us investing in high-carbon infrastructure. So partly why this research is important and why we're talking to the stock exchange, the investment managers, the investment analysts, the pension funds, is because we need to make some long-term investment bets. If we keep re-upping into high-carbon infrastructure, more coal-fired generating power plants, we're simply going to lock into the same high-carbon infrastructure. That's not going to help. Absolutely, electricity prices can be used as a proxy for carbon footprints, kind of a layman's thumbnail guide to what's possible. But the different sectors, for example, on the JSE, according to the research by our partners, and just to mention, there's work by TrueCost out of London, Carbon Tracker out of London, WWF contributed, as well as SinCo. Well, some of the key sectors that are going to be affected are food and beverage, are basic materials and resources. So there'll be different ways this plays out, and to be sure, the cost of the carbon tax and how it's applied is still being negotiated. So that's still going to play out in different ways. Water scarcity, though, we already see it playing out. It's playing out in the Zoutpansberg, it's playing out in the Waterberg, where you have coal mining companies fighting agriculture, debating local communities about whose water is it and what's going to be the impact. There's not enough water to go around. Now, how are we going to make some of these trade-offs? And who's going to be factored into that investment decision? Where is that capital going to be deployed? And if we're not even checking for the numbers, well, how can we make an evidence-based research decision?
Mm-hmm. Of course, it forces you to more acutely look at changing regulatory environments as well. And with that coming into focus, certainly here in South Africa, is the planned carbon tax and the kind of implications that would have on companies moving forward, and just the basic costs, of what you're investing in.
Right, and what we're talking about is we're talking about externalities, right? So, for example, in the presentation I showed, and we had a great event here at the JSE. We had the most powerful pension fund in Africa. The JSE was represented a number of NGOs and investors. I used a cartoon, and the question is, well, what are we going to do about mine safety? And in the cartoon, one manager suggests, well, why don't we just put the headquarters or the sea-level suite inside the mine? Right? It's a way of closing loops. There's no negative externalities if everything's accurately priced in. So one should see carbon taxes as just a way to actually count the cost of something that's already happening. Now, there's the longer term impacts of climate change. There's more CO2 in the air than there was 200 years ago. That's going to create huge problems for future generations. But more directly, if you've ever been to Vanderbijl Park in winter, you know what smog looks like. You know what coal-fired power plants, what kind of emissions they generate. Now, there's technologies to get at that. And that's part of the upside of this research series is the next steps. There's no-brainer next steps that are positive that we could actively take if we thought strategically about this and move the investment capital in South Africa in these directions. Some next steps at a regulatory level, absolutely. Let's create more green bonds. Let's find ways to get fixed income investment into green economy sectors and create jobs at the same time. And there's also the importance of regulation to make sure, well, let's have companies disclose how much water are you using.
Graham, finally, nice and brief if you can.
Sure.
Are companies taking you seriously? Are investors taking you seriously, or are they just saying to themselves, look, let's move Johnson from accounts into a new role and we'll call him our green executive? You know, are they just going to put a little piece in their annual report in order to appease organisations like the WWF, or is this being taken very seriously?
Lindsay, it's being taken very seriously. I think there's still kind of a leader cohort. There's a first mover advantage, both at the investment manager level and at the company level. There's some real leaders there. And when South Africans lead, bear in mind, they lead globally. They develop global best practices. But absolutely, in our report, for example, we are concerned about the problem of greenwashing, where companies say one thing and do another, where investors promise a policy, but it doesn't play out in practice. That is something to be watched for, and don't be surprised in a year's time where maybe follow-up reports start to look at those issues. But net, it's a really positive research series, the Navigating Muddy Waters research series. It points to a whole bunch of next steps that we could take today to invest in a low-carbon future.